you need to pay somebody to come over and cook your meals. It can be used for that. So it can be, as you're fond of saying, stay out of the nursing home insurance. I'm 59 and expecting some health issues in my future. I have about $2 million in various accounts. Should I self-insure or should I get some sort of policy? If I go with a policy, what kind should I look at? All right, Gary, well, let's ask a question back to Gary here. John, the first thing we need to clarify is what type of health is he trying to insure?
Yes, if you're talking about just regular everyday health insurance, that's one issue. If you're talking about something that would cover a chronic long-term issue, that's a completely different situation. Obviously, everybody should have some form of health insurance that covers doctor's visits, hospitalization, things of that nature. But it sounds to me like that Gary is talking about things that would cover home health care, nursing home care, things that you're really not going to find coverage under your normal health plan. And if that's the case, then Gary has some decisions to make.
Yeah.
$2 million, Scott, really is kind of in that kind of no man's land, I'll call it, in terms of whether you have enough wealth to self-insure against a major long-term care issue.
Yeah. So first of all, I think Gary needs to really work towards building a retirement income plan to see how much of his $2 million is going to be needed to sustain everything else, right? We're looking at that health problem, the long-term care component of that, and it needs to be done holistically. What are you going to need to pay your bills? Do you have a big mortgage? Do you have a lot of debt? Make sure all those boxes are checked. And even to the point of discretionary income, what are you going to do in retirement? So your lifestyle is set, and we may not need all $2 million of your assets to provide that for you. So that's the determining factor of if there's going to be money on the sidelines that is not needed for your retirement income that you could use as a self-insured long-term care bucket. But that also is subject to change from other things that might happen as well. So you do have to be careful, as to John's point about no man's land, of assuming that this is going to be enough and I'm just going to self-insure.
Well, and you also, Gary doesn't say whether he's married or not.
Yep.
And you have to think about the support of the, I'll call it the non-impaired spouse.
Yep.
If someone has to have home health care or nursing home care, that spouse also has to have living expenses. And so you walk this very fine line trying to depend on your your retirement accounts to provide for all things in that situation. And that's where the long-term care insurance comes in. Long-term care insurance is designed to step in and pay the bills or offset some of the cost that nursing home care would impose on a family. And that will leave the assets intact for the non-impaired spouse to continue their lifestyle. There are things that they require and desire in their lifestyle, in addition to taking care of their impaired spouse. So it is a very complex situation. And Scott, there are a couple of different ways that you could approach this. One we don't particularly care for. The other we actually do like a lot. We're not big fans of individual standard long-term care insurance, because rates go up on that. There's a paper chase that goes on as far as the claims program is concerned. We really do like the idea of using a hybrid life insurance policy that uses the death benefit as a pool of money that can offset long-term care expenses.
Yeah, so the key there is you have a level premium. So day one, your cost is the same as 20 years into that because it is a life insurance policy. It may start out a little bit higher, the premium on day one, than the traditional long-term care policy, but you have to understand that's because somebody is getting paid. You're buying a pool of money that, let's say it's $100,000. If you drop dead suddenly and don't need long-term care, then that $100,000 is going to go to your beneficiary. Could be a spouse, could be anybody you name, of course. If you need some or all of that $100,000 to provide yourself with long-term care coverage or meet long-term care expenses, then you would begin to draw off of that pool of money. When it's gone, it's gone. But if you don't use all of it and pass away, then you do still have a death benefit residual there for your beneficiary. And I think the other key piece and why we like it so much, John, is that it does not require you to be in a nursing home and have nursing home care. You only have to check a couple of boxes. If something happens to you and you cannot conduct 2 of the 6 activities of daily living, then you're going to be on claim and you're going to begin starting to receive a monthly check, monthly income, a preset amount before when the policy is issued. And that will be able to go to be utilized any way you need it to be. If you need somebody to pay, you need to pay somebody to come over and cook your meals. It can be used for that. So it can be, as you're fond of saying, stay out of the nursing home insurance.
Yeah, and I really have to caution people not to fall into the thought process of, that's not going to happen to me. Yeah. Well, here's the statistics. 70% of the people listening to this broadcast right now, 70% of anybody in America will need some sort of long-term care in their lifetime. Now, that might not mean I'm going to be in a nursing home. I get that. Most people are very resistant to that idea. They'd like to be cared for at home. So let's talk about what that cost is. Nationwide, the cost of home health care runs about almost $6,000 a month. In Arkansas, it's a significant amount less. It's about $3,700 a month. But just think about having another $3,700 bill that you have to take care of. Financially, how would you do that? And, Scott, when you think about $2 million of assets, if you're providing, $7,000 or $8,000 a month in income to the family, another $3,700 is a big load to throw on that $2 million. You can run into a situation where you're very vulnerable to asset depletion, and that's not something anybody wants to get into.
No, if you're 59, like our caller here, or rather our viewer here that sent in the question, and you have not addressed long-term care, you're sticking your head in the sand, so to speak, about that. Don't do that any longer. You have to stop ignoring the long-term care piece to your retirement plan and make sure you've addressed it and made a plan for it wherever you land, whether it's self-insuring or a long-term care insurance policy. This is the question of the week. Thanks to Gary for sending that in. And we will send you, Gary, a free Get Ready for the Future show tumbler for being named the question of the week. Just email us to claim it. Send it to show@getreadyforthefuture.com.